This text paints a picture of significant economic challenges facing Germany, characterized by strained relationship with China. The postponement of the foreign minister's trip due to limited meeting arrangements suggests a growing distance or dissatisfaction in diplomatic relations. However, China remains a key trading partner. Concerns over critical mineral exports. China's tightening control over these exports raises anxieties for German tech and manufacturing industries. Economic slowdown and vulnerability. The text highlights a decline in factory output and a sense of unease about Germany's economic future. It suggests that long-held assumptions about the country's stability are being challenged. Multiple economic shocks. The pandemic, energy crisis, sanctions, and tariff battles have all contributed to the current economic difficulties. Potential shift in economic power. There is concern that Germany's economic crisis could lead to a reshaping of the global economic order, with other countries potentially seizing the opportunity to gain influence. In essence, the passage suggests that Germany is facing a serious economic crisis that threatens its position as Europe's economic powerhouse. The combination of external factors and internal vulnerabilities has created a situation where the future is uncertain and the old certainties no longer hold. This is a bleak but compelling summary of the German economy's current state and China's potential offer of aid. Here's a breakdown of the key issues and implications, key problems facing Germany. Economic slowdown, or recession. Declining orders, shrinking margins, and uncertainty point to a significant economic downturn. Deutsche Bank and Handel's Blatt confirm a recession. Automotive industry woes. German automakers are losing market share, a critical blow to the country's industrial reputation and economy. Inflation and high electricity costs. These factors squeeze businesses and consumers, further depressing economic activity. Loss of investor confidence. Capital is flowing out of Germany to regions seen as having better growth potential. Brain drain. Young specialists are leaving the country for better opportunities elsewhere. Erosion of Germany's image. The perception of Germany as a stable, leading European power is weakening. The country is struggling to adapt to the modern global economy. China's offer? Unprecedented scope. The offer is described as highly significant. Dual nature. It's framed as support, but also aims to reshape European influence. Package components, low-interest loans, long-term access to critical minerals, advantageous terms for German automakers in China, collaborative technological initiatives. Timing. The offer comes at a moment of extreme German vulnerability. Concerns about the offer. Conditions. The Financial Times analysts emphasize that the conditions attached to the offer could significantly impact German industry and foreign policy. This is the central concern. What concessions will Germany have to make in return for China's support? Loss of autonomy. The implied fear is that Germany could become overly reliant on China, potentially compromising its independence in foreign policy and economic strategy. Shift in power balance. The text suggests that this offer could significantly alter the power dynamics within Europe, potentially weakening Germany's influence. Overall implications? Potential for economic recovery. The offer could provide a much-needed lifeline to the German economy, helping to stabilize key industries and attract investment. Risk of dependence. Germany risks becoming overly dependent on China, potentially sacrificing its strategic autonomy and long-term economic competitiveness. Geopolitical shift. The acceptance of the offer could significantly shift the balance of power in Europe and globally. This would have broader consequences for international relations. Sources mentioned: Deutsche Bank, Handel's Blatt, Der Spiegel, South China Morning Post, Financial Times. The text highlights a critical crossroads for Germany. It needs to weigh the immediate benefits of China's offer against the potential long-term consequences for its economy, its political independence, and its role in Europe. This text describes a complex geopolitical and economic situation in which China is making a significant proposal to Germany, potentially creating a rift between Germany and the United States. Here's a breakdown of the key points. China's offer. China is reportedly seeking more than just trade benefits from Germany. It wants equity stakes in critical German sectors, energy, logistics, mechanical engineering, and a greater voice in Germany's foreign policy. Strategic implications. This move would complicate Germany's relationship with the United States, particularly in areas where US and Chinese interests diverge. It could signal a shift towards a new geopolitical alignment based on practical cooperation rather than traditional alliances. Germany's dilemma. Chancellor Merz faces a difficult decision. Germany is caught between US tariffs. Trade policies from President Trump are harming German exports. And then China's economic opportunity. China's offer could provide short-term economic stability. Long-term concerns. While China's proposal might offer immediate relief, it could leave Germany vulnerable to long-term Chinese influence. Internal division in Germany. German opinions are split. Some business leaders see China as an opportunity, particularly given China's control over critical resources like rare earth metals. Chinese leverage. Experts believe China strategically created dependencies to increase its bargaining power with Germany. Behind-the-scenes talks, private discussions between German and Chinese delegations have been ongoing for weeks. In essence, the text portrays a scenario where China is leveraging its economic power to potentially reshape Germany's economic and foreign policy orientation, challenging the traditional transatlantic alliance. This article discusses a potential agreement between China and Germany where China offers a significant aid package in exchange for access to strategic infrastructure facilities in Hamburg, Duisburg, and Leipzig. Here's a breakdown of the key points. The offer: China is offering a substantial aid package, nearly 20 billion euros, including subsidies, loans, and shared investment funds to Germany. The catch: in return, China wants guaranteed access to key infrastructure hubs, Hamburg, Duisburg, and Leipzig. These cities are vital transport and production centers, not just for Germany, but for Europe. Strategic implications. Accepting the deal would give China significant influence over the arteries of the European market. This would have far-reaching consequences beyond just Germany. US absence. The United States is surprisingly quiet on the issue, seemingly more preoccupied with domestic matters than countering China's growing influence. Trump's tariffs. President Trump's tariff policies have exacerbated the economic difficulties of German industries, creating an opportunity for China to position itself as a stabilizing force. Economic takeover. The Economist Intelligence Unit describes the situation as a subtle economic takeover, relying on strategic financing, infrastructure deals, and industrial partnerships. Internal conflict in Germany. German policymakers are divided on whether to accept China's offer and risk sovereignty or reject it and face further economic decline. The government is taking a cautious approach. Historical decision. Germany faces a critical decision: remain committed to traditional alliances that offer limited relief or align with China, a nation aiming to reshape the global system. China's existing influence. Reuters reports indicate that China is already influencing major economic discussions across Europe, highlighting their increased leverage. This passage paints a concerning picture of the German economy, highlighting its struggles and the potential implications of a proposed deal with China. Here's a breakdown of the key themes and arguments. Economic difficulties. Germany's industrial powerhouse is facing significant challenges due to high energy costs, resulting from the loss of Russian gas, rising production costs, and declining orders from key markets like China and the US. Major companies are reducing staff, closing production lines, and relocating. Structural transformation. Economists view these problems as deep-seated and not merely temporary. This suggests a fundamental shift in Germany's economic landscape. China's opportunity. China is offering a joint industrial alliance to Germany, leveraging German technology in exchange for Chinese financial resources and access to German advancements in key sectors: electric vehicles, robotics, energy technologies. Potential power imbalance. While Chinese media portray the deal as mutually beneficial, European analysts are wary, seeing it as a strategic move by China to absorb a weakened German economy. Political divisions. The proposed deal is causing internal conflict within Germany, with some seeing it as a necessary lifeline and others fearing it as a loss of economic control. In essence, the passage argues that Germany's economic model is under severe pressure, making it vulnerable to external influence. China is strategically positioning itself to capitalize on Germany's weakness, potentially reshaping the economic relationship between the two countries. This situation is fraught with political and economic risks for Germany. This passage describes a complex geopolitical situation involving Germany, China, the European Union, and the United States. Here's a breakdown of the key issues and their implications, key players and their positions. Germany. Facing an economic crisis with a burdened financial system, falling exports, and declining industries, it's caught between accepting a Chinese offer that risks long-term dependence and facing the consequences of not accepting it. It also seeks to balance its economic interests with political pressure from allies. China, offering a proposal, presumably financial or investment, to Germany, demonstrating economic resilience despite U.S. tariffs and leveraging its growing influence in global commerce. European Union, specifically France and Germany, divided on how to handle China. France advocates for limiting China's reach, while Germany prioritizes stabilizing its own industrial structure, potentially at the expense of limiting Chinese influence. United States, President Trump's administration, applying economic pressure on Germany, accusing it of unfair trade and weakness toward China, refusing to intervene in Germany's crisis, and pushing it to resolve its issues independently. Core conflicts and tensions. Germany's economic crisis versus Chinese influence. Germany's desperate for economic relief, making it vulnerable to accepting potentially unfavorable terms from China. This creates a tension between immediate needs and long-term strategic independence. EU disunity on China policy. The EU is divided on how to deal with China's growing influence. This internal disagreement weakens the EU's ability to act decisively and creates opportunities for China to exploit these divisions. US pressure on Germany. The US is putting pressure on Germany to resist China's influence, but without offering any support or solutions to Germany's economic problems. This creates resentment and makes Germany more likely to consider alternatives, even those with potential risks. China-US trade relations. The passage mentions a temporary truce in the China-US trade war, which slightly decreases tariffs. However, the truce is fragile, and China's increasing trade surplus continues to fuel tensions with governments concerned about its growing economic power. Key themes: geopolitical power dynamics. The passage highlights the shifting balance of power in the world, with China's growing influence challenging the traditional dominance of the US and Europe. Economic interdependence and national sovereignty. The situation raises questions about the balance between economic interdependence and national sovereignty. This article discusses the challenges and adjustments in China's export economy. Here's a summary of the key points. Doubts about sustained growth. Concerns are growing about China's ability to maintain its economic strength, fueled by an unexpected contraction in October exports. Shifting export patterns. China is navigating challenges in the U.S. market and seeking growth in other regions. Decline in U.S. exports. Exports to the U.S. have significantly decreased, nearly 18% in the first 10 months of the year, compared to the same period in 2024. Growth in other regions. Exports to the European Union, ASEAN nations, and Africa have increased significantly. Overall export growth. Despite the decline in U.S. exports, overall export growth has reached over 5%. Drivers of growth in new markets. Demand for various products is driving growth in different regions. Southeast Asia, machine tools, auto parts, and computer components. Africa, construction machinery and renewable energy technologies. Latin America, electric vehicles, fertilizers, electronics, and other manufactured goods. Domestic challenges. Despite outward strength, China's manufacturing sector faces issues. Weak domestic demand. This makes the manufacturing sector even more crucial. Uneven manufacturing conditions. Workers report cancelled shifts and rising uncertainty as production moves overseas. Efforts to adapt. Factories are trying to replace lost U.S. orders with business from other regions. Impact of U.S. tariff policies. Inconsistent U.S. tariffs have discouraged investment and pushed companies to seek new markets. This text provides a concise overview of the challenges and adjustments faced by Chinese manufacturers in the face of global trade uncertainty, particularly due to changes in U.S. trade policy. Here's a breakdown. China's export surge, questioned validity. The text raises doubts about the nature of China's recent export growth. There's a suspicion that it might not be purely driven by genuine demand, but rather by exporters strategically moving goods to foreign storage in anticipation of future trade deals. This implies a hedging strategy to avoid potential trade barriers or tariffs, circumventing trade restrictions. It mentions evidence suggesting that some Chinese goods are still reaching the U.S. market through third-party countries, implying attempts to bypass trade restrictions. Price pressure and profit margins. Even with rising shipments, exporters are facing challenges due to lower prices necessary to maintain sales volume. This squeezes profit margins and leaves companies vulnerable to economic shocks. Focus on domestic market. The text highlights a strategic shift towards the Chinese domestic market as a safer and more stable source of demand compared to the volatile global trade environment. Individual example. Wang's case illustrates this trend. Despite finding some success in foreign markets, he's prioritizing building a stronger presence within China to ensure long-term stability. He recognizes the importance of aligning his business with the purchasing power of Chinese consumers. U.S. trade policy as a disruptor. The text explicitly blames the U.S. for shaking up the foreign trade scene, leading to global uncertainty and chaos. In summary, the text paints a picture of Chinese manufacturers navigating a complex and uncertain global trade landscape, shaped by U.S. trade policies. This involves a combination of strategies attempting to bypass trade restrictions, lowering prices to maintain sales volume, and increasingly focusing on the domestic market for stability.